So absolutely delighted to have Shawn Kravetz here with us today. Shawn Kravetz is the President and Chief Investment Officer of Esplanade Capital, an investment management company he founded in 1999. Esplanade Capital manages capital for a small number of like-minded families, private investors, and institutions. Prior to the founding of Esplanade, Shawn was a corporate executive and strategic advisor, including principal at the Parnes Group, a leading strategy consulting boutique where he advised chief executives on corporate strategy, director of strategic planning and corporate development at the CML Group, where he oversaw activities at subsidiaries including Nordic Track, The Nature Company, and Smith & Hawken, consultant with Mondor Company, a leading strategic consulting firm. He formerly served on the board of directors of Nevada Gold and Casinos, where he was chairman of the Corporate Governance and Nominating Committee and a member of the Compensation Committee. He currently serves as trustee and chairman of the Investment Committee at Temple Israel, Boston. Thank you for joining us today, Mr. Kravetz.
Nice to be here. Shawn, please.
Excellent, thank you. So can you please discuss you have a very heavy focus on the solar industry, and can you discuss sort of what inspired you to have that focus and sort of why you find that industry in particular attractive?
Absolutely, and it's a delight to be with you. I am a huge fan of Brown University, always have been. I've spent a lot of time on Thayer Street. I've gone to Campus Dance, and I'm a big fan. So I founded Esplanade in 1999. We began investing on January 1st of 2000. I used to call Esplanade Capital the world's smallest hedge fund. It wasn't. It felt perilously close at the time and occasionally still does. But at the time, and I might add, launching the world's smallest hedge fund on the eve of a 40% decline in the S&P 500 on January 1st of 2000 is not the most auspicious time to start your own money management business, but we survived. And at the time, we actually didn't invest in solar or the energy transition, as you said. We were very focused on a handful of sectors, a handful of industries where I had real life work experience and where I knew we'd see opportunities long and short in the capital markets. But solar was not one of them until 2003. In 2003, a couple of very important things happened. One is the stock market stopped going down and started going up, which was nice. And two, we started to do some research on what at the time was this little tiny industry called solar. And in the US, it was really nothing. It was perceived as a sort of Berkeley, California, uneconomic, hippie, lunatic fringe sci-fi movie. And some of that was justified. But if you spend time in places like Southern Germany, which we did, Japan and elsewhere, solar was starting to become a way of life. Applying for a loan to put solar panels on your roof was not much different than applying for a car loan. Very, very different than it was in the US at the time. And as we got to know many of these companies, they had great management teams, growing very rapidly, addressing, a $1 trillion global market called turning the lights on. And yet, even though the universe was very small at the time, it's since exploded. When these companies went public, they didn't trade at terribly demanding valuations. And unlike a lot of megatrend or hyper-growth oriented industries and companies, these companies actually did kind of a funny thing. They actually made money. And to us, as sort of boring, value-oriented investors, that was really the catalyst for action. We did hundreds of person hours of on the boots, proprietary due diligence around the world, and finally got comfortable enough to deploy our first dollar of partner capital. And that was about 18 years ago.
Yeah, that makes a lot of sense. And then can you speak specifically more about, how do you analyze these solar companies? I guess, how much do you look at it at a per company level? What sorts of things are you looking for? How much of an emphasis is there on management? Are you looking more on, let's say, the macro regulation that's affecting the sector as well, and the actual incentives they receive, all those types of things?
Yes, and yes. What started as solar has really blossomed into the energy transition. When we first started doing this, the universe of publicly traded solar companies was about 40 companies around the world, tiny, about 40 billion in global market cap, minuscule. Today, by our math, it's really blossomed into over 1,000 companies with approximately $6 trillion in global market cap, although less after the past couple of weeks. So it's really blossomed and expanded into a much more holistic energy transition because once upon a time, there were solar companies, there were wind companies, there were utilities, but the lines have really blurred. And so that, to answer your question, Itai, that's the first part, is just thinking about what this business is, what they do, who their competitors are. A company today like Sunrun, viewed as a residential installer of solar panels in the US as one example, and we happen to own the stock today. It recently brought in a new CEO who used to run a utility. Now, if I had told you that 10 years ago, that would have been at best very, very forward thinking and looking, but maybe sort of farcical. But the lines have blurred. So one is really thinking about the business a company is in and expects to be in the future, and how that impacts their competitive set and what they need to succeed. But solar and the energy transition really requires, in our view, both an incredibly rigorous bottoms-up view of the world, understanding business economics, balance sheets, cash flow statements, et cetera, how a specific company creates value, how that company is perceived as creating value and is valued by all the different investors around the world that comprise global stock markets. It can be very, very micro because, spot silicon prices coming out of China on Wednesday mornings, can make a big difference to stocks around that world that day. So you have to master the micro. With that said, the macro is also essential. Now, when I say macro, in this case, I'm not really referring to, the global macro hedge fund view of the world. If you have particular skills there, wonderful, predicting interest rates and exchange rates and this and that. And that's not to say that those aren't very important things with global companies, with long-lived assets. Those things really matter. One's ability to predict them is a little bit suspect. When I say macro, I am talking about big industry trends. I'm talking about, as you mentioned, government policy around the world. The global solar industry is where it is today because of the largesse of governments around the world. Originally, Germany and Japan with very, very generous feed-in tariffs, providing great, predictable, robust incentives to deploy a lot of solar in their respective countries. Whereas once upon a time when, Angela Merkel sneezed, the global solar industry caught a cold. Today, German subsidies are very, very close to zero. Subsidies have fallen dramatically in every market and have gone to zero in most of the markets that matter around the world, including India, soon China, much of Europe. But understanding the policy, that sort of big picture macro policy, et cetera, has always been and continues to be incredibly important. And so our job is to do our best, understanding the top down, understanding the bottoms up, and then finding very, very carefully researched and diligenced opportunities for both investments and trades. And at Esplanade, in our funds and strategies, we are very active in sort of both sides of that equation.
Yeah, I think that makes a lot of sense. Could you also please speak to us about how prominently you believe the use of various energy sources will be going forward?
Different energy sources have different pluses and minuses. Economically, in terms of storage, obviously, in terms of carbon, et cetera. And so, individuals and governments and corporates need to decide how to make those trade-offs. Just as one example today, unfortunately, with natural gas prices spiking in Europe, there's been a real incentive to use dirtier fuels like oil recently, instead of more natural gas, just because it's cheaper. And even once one buys whatever carbon credits are required because of the dirtier emissions, that math sort of pencils out. So we have always viewed renewables as sort of a part of the whole, not necessarily the whole, and different technologies and different fuels which can peacefully coexist with one another. When we started to get very involved in solar, almost 18 years ago, investors and prospective investors would ask, well, what about wind? Why not wind? Or it doesn't need to be a winner take all game. It depends where you are geographically, how much sun you get, how much wind you get, when you need the electricity, how cheap has storage become, et cetera, et cetera. So there are a lot of factors, and a lot of renewables can peacefully coexist with one another. With that said, a lot of people say, well, I'm waiting for the tipping point. When's the tipping point? When does solar become cheaper than coal or natural gas or whatever? And the bottom line is it varies depending on where you are in the world. And in many cases, it's already happened. We have already tipped. So we're not waiting for a tipping point. We are past the tipping point. Just as one example, as a percentage of new incremental energy generation capacity installed, solar and renewables are the majority worldwide. We're not really building a lot of new nuclear. There's very little new coal. On the margin, and again, economics and finance and much of life is on the margin. On the margin, it's solar. So we have tipped. When we started investing in solar 18 years ago, there was 1 gigawatt of solar installed worldwide. That's about the size of one large traditional coal-fired power plant that they're not building any more of in the United States. Right now, we're installing about 150 gigawatts of solar every year worldwide. It's 150x growth in 18 years. So that has happened in part because of the generous subsidies of years ago, in part because of the second order effects of driving the entire industry down the experience curve, lowering costs, lowering prices, and hence the levelized cost of electricity around the world. And part of it is it's just cheaper today. In many parts of the world, it is cheaper to generate electricity with solar than anything else anyone can use. So these things peacefully coexist. We believe solar is very well positioned to continue to take share. And as I mentioned earlier, cost-effective storage will only hasten that process. For the past 15 years, storage and batteries have been a year away from being cost-effective. We may finally be a year away. A third of all the solar installations residentially in California have some sort of storage attachment. That's just a tailwind to the entire renewable energy worldwide.
Yeah, I think that makes a lot of sense. And so in that case, how do you see, I guess, in the long term, the role of coal, natural gas, and oil? Do you think we're really close to approaching, peak oil demand, peak natural gas demand, peak coal demand, or do you think that's still, let's say, a few decades away?
No, I believe we're there. And again, this is not a, climate change argument. This is not wishful thinking. It's just the reality of economics and all of the forces out there trying to help mitigate climate change, trying to make the world a better place for us, for you, for my children, their children, et cetera, et cetera. So it is real. And it's happening right now. There's really, quite frankly, there's no way of stopping it. And I don't think anyone really wants to.
Yeah, I think that makes a lot of sense. Are you concerned at all with, I mean, some of these, for example, let's take copper. Copper, a lot of these renewable energy sources, they take a considerable amount of copper to build. And, they have to be, I don't know sort of what the lifespan is for solar, but, once you install new ones as well, there's been sort of issues with copper supply. It's struggling, to ramp up. It's in a lot of jurisdictions that are maybe more third world jurisdictions where you have a lot of geopolitical risk. How big of a concern is that for you going forward, that sort of the pace at which these renewables will be adapted will be limited by shortage of these metals?
So it's a very real issue. It's partly shortage and partly just cost. It's metals like copper, aluminum, steel, glass, uh, silicon manufacturing, spot polysilicon prices have tripled in the past 3 years. That's sort of the key building block of a solar wafer, which becomes a solar cell and a panel. Lithium, cobalt, and other things. Again, we're getting a little bit more into the storage side of things, but these are all real gating factors on growth. Unfortunately, there's a concept called energy return on investment. And it's very, very important here. And it is, it thickens the plot because, if you put gasoline in your car, if you put coal in a coal-fired power plant, those are very dense. You get a very substantial energy return on that energy investment. But to generate electricity from a solar panel, first you have to build that solar panel. That requires all the materials you just, enumerated. That uses a lot of electricity, and you get paid for that over the life of that asset, which can be 20 or 25 years. So it's a little bit of how you as an investor think about, a discounted cash flow, but for energy. That's really what we're talking about here. And if the goal in some respects were to just improve energy consumption today, just for today, you might not manufacture a solar panel because the energy it takes to make one is not paid back immediately. It takes time. But I think, like many investors who ultimately think about the net present value of the future cash flows, et cetera, that's how we have to think about energy. And there will be some short-term gains, some long-term investments, et cetera. Again, trying to reduce our dependency on fossil fuels and the emissions they create. Finally, I would add that, at Esplanade, we talk about investing at the intersection of decarbonization and electrification. The world is electrifying. So your apartment, your house, your car are electrifying. Now, even as a bigger and bigger percentage of new cars sold around the world are electric, the installed base is so large, it takes years and years and years for electric cars as a percentage of the installed base to grow to a sizable number, but it's happening. And as the world electrifies, again, that just naturally reduces the dependence on oil, which is really a transportation fuel, and increases the dependence on electricity. The big question is, where is that electricity going to come from? We expect the majority of it to be renewables.
How do you think we'll get to a point where, I think one of the challenges now, from my understanding, with renewable energy is the transportation of it over long distances. Do you think we'll get to a point where you would be able to, let's say, have, let's say, energy generated in really, fertile solar environments, let's say in the middle of deserts, and for that to be transported to other places on the continent? Or do you think that's something that, the prospects for that don't like get in the long term?
No, I actually think we have good reason to be very optimistic about it. Again, there are no free lunches. Transmission and distribution cost money. There is yield loss, so it's not free. But you see it in the desert Southwest, where you have electricity generated in wide open areas where land is inexpensive, where the solar radiation is very high, and it's transmitted through the grid to places that need it most, Southern California. But there is a cost. There is a very substantial investment that is going to have to be made in the grid infrastructure around the world to support that. And unfortunately, with solar as an example, its Achilles heel, it used to be in addition to cost, but that's become much less of maybe there were two Achilles heels. Now there's only one. It's that it doesn't exactly get generated when you need it most. In part it does. In part it does on a hot August afternoon where you turn on your air conditioner and you need lots of electricity just as the sun is beating down on your roof. That's wonderful. Unfortunately, at 8 o'clock that same very night, when it's still 85 degrees in your apartment, but the sun has set, you need the grid, you need backup storage, you need something. And so again, to the extent that you can generate as much of that electricity as possible in the most cost-effective manner possible, and then get it to where it's needed when it's needed, ideally with some storage, now all of a sudden we're talking about a system that can work.
And how do you see the role of nuclear energy going forward? I mean, it's one of the sort of the few energy sources that it is more environmentally friendly. It has, what you were discussing earlier, a higher efficiency than oil and natural gas, from my understanding. But because of some of the past sort of catastrophic events that have happened, there's been a lot of hesitancy, even from very climate-friendly governments, to really institute it. And even we've been seeing a lot of nuclear power plants being even closed lately. So do you think in the long run that sort of sentiment will turn around and we'll see a lot of these being built, or do you think that really nuclear will sort of maintain sort of the reputation that it has today?
It's a wonderful question. Nuclear power is a very, very divisive issue. And as you said, many countries that have been extremely successful with nuclear power, generating, carbon-free, very low cost, very safe electricity, have been pulling back. Germany coming out of the Fukushima disaster, and Japan, I guess in 2011, is sort of the perfect example of that. We see France, a pioneer in nuclear power, scaling back, etc. From a carbon perspective, that's an enormous problem because there just aren't enough renewables coming on stream fast enough to fill that gap. And so we are trying our best to fill it with things like natural gas, which has its own limitations. Once upon a time was viewed as sort of a bridge fuel and is less bad than many alternatives, but not as good as many of the things it's displacing. It's a real problem, and clearly there are very, very real issues and concerns around nuclear power, and the world is going to have to figure it out. It has the potential to be a very efficient and effective part of let's call it the energy arsenal around the world. But the world is clearly moving in the opposite direction. And as a result, many of the things that would have to happen for, nuclear to sort of rebrand, to be, most importantly, be safe, and also importantly, to look safe in the eyes of future generations, those things just may not happen because, it's a very, very difficult position to be in to, be the one holding the sign saying, go nukes, go. I don't know a lot of people that want to be in that position. And as a result, there is some risk that it just becomes incrementally marginalized at a time when the world needs as much cost-effective carbon-free power as it can get. Again, I'm not advocating for nuclear being the answer, but It is likely a constructive debate. I fear that nuclear may lose that debate.
Yeah, I think that makes a lot of sense. By the way, is Esplanade Capital entirely invested in solar companies?
It is not.
Okay.
Originally it was, but over the years, our investment universe has really blossomed. We liken it to how when a tree grows, it has sort of concentric rings that grow. And that's very much how we think about our investment universe. That core nucleus of solar remains. It has always been and will always be a very, very important part of what we do at Esplanade. That universe itself has grown dramatically. Lots more companies, lots more market caps, including recent IPOs in recent years, which is very, very exciting, including some through de-SPACs very, very recently. But the next ring out for us is companies for whom solar is a piece, but only a piece of their business, of their economics, of their value. I think of a company like Hannon Armstrong Sustainable Infrastructure, a company we are not shareholders of today, but a company we were for many, many years, one of our best investments in the history of the firm, one of the best management teams we've ever known in any industry. And we got to know them really with partly a solar angle, but partly a sustainable infrastructure angle. The universe includes other forms of renewable energy. And the largest part of our universe today are really, legacy energy companies impacted by the energy transition. And what I mean by that is largely utilities. We were short utilities in the past when renewable energies, most specifically solar, started to eat their lunch. Think back of German utilities a decade ago coming out of Fukushima. Their hands were tied because of nuclear, and Germany was installing 7 gigawatts of solar a year, year after year after year, destroying their business economics. We fast forward to today, those utilities in North America, for example, who have embraced renewables, think about a NextEra, for example, which we own, they have seen more durable earnings, larger earnings base, and multiple expansion. For a value investor, that's a really wonderful DuPont formula there for creating value. So we are involved in utilities. We do not claim to cover, the 1,000 utilities in our universe, but one by one, there are opportunities there, long and short. And then finally, maybe the bark, if I can just bludgeon that tree metaphor, the bark of our investable universe are really the disruptors. These are companies involved in electric vehicles, electric vehicle charging, some storage, companies that are not necessarily the garden variety, value oriented and growth at a reasonable price investments that are our bread and butter, but they are part of the future, and they play an important role in the energy transition. So, we love pure play solar, the First Solars, Solar Edges companies, you've heard of, but the universe today is much broader than that. And to succeed in this industry, and I think many today, one really needs to maybe not be a polymath, but to understand that big picture of where these companies sit, and looking at it through a very narrow lens of solar or wind or geothermal or utilities, I think is a recipe for disaster, because I think you wake up and you are blindsided by just something you didn't expect that you could have known about had you just thought more holistically about the investment universe in which you invest.
Yeah, I think that makes a lot of sense. And I mean, we've spoken about, already several different countries in which you invest. How do your investments look geographically? Are you basically just open to investing in any region, or do you have specific regions that you exclude or specific regions that you include, or those types of things?
So we at Esplanade invest globally. that is essential for our investment universe because the universe is global. Once upon a time, virtually all of the activity was in Europe. Most of the manufacturing was in Europe, from solar panels to equipment that made them, to owners of those assets that were publicly traded. And by the way, almost all of the solar manufactured worldwide was installed in Europe, principally Germany, but France, Italy, Spain, and elsewhere. The next wave of the evolution of the industry was that most of the consumption, if you will, remained in Western Europe, but China and Southeast Asia really took over the manufacturing of polysilicon, wafers, cells, modules, equipment, everything. And we were fortunate. We, were successful playing that transition long and short, but it led to a very strange setup, which was that, Germany was the customer and China was the manufacturer. In recent years, Europe basically collapsed as the incentive schemes in each of the countries, and by schemes, I don't mean anything illicit, I just mean sort of programs or structures, they were all exhausted. Spain, in and about 2008, went from installing almost no solar to, in 2008, 2009, becoming the largest country of solar installation in the world out of nowhere. But then all of the incentives dried up and it went back to zero. In a different way, the same thing happened in Italy. And in a slower fashion, the same thing happened more or less in Germany. So Europe collapsed as a consumer of solar panels after it had already been euthanized as a manufacturer of solar materials. And in recent years, China has gone from buying zero panels to becoming the largest consumer of solar panels in the world. In fact, what gave the industry, let's call it myocardial infarction in 2018 was the fact that China had become such a huge consumer. It was actually too much. And China developed sort of a case of indigestion, having gone from zero to more than half of global solar demand, consuming over 40 gigawatts of solar per year. They pumped the brakes, and that sent shockwaves through the industry. The solar indices were essentially cut in half that year, largely because of it was more than a speed bump, it was a roadblock that hit in China. So we do invest globally. Today, the largest players in each of the market segments are really distributed around the world. Interestingly, after being particularly active in Asia, and by Asia I mean mostly China, Hong Kong, and Japan, we've actually been more active in North America than we've been for a long time. We are seeing opportunity, and it's delightful when it's essentially in your backyard. Particularly during a pandemic when, visiting companies, doing the type of work that we love to do, we haven't been to China for a long time, let's put it that way.
Yeah, I think that makes a lot of sense. And you spoke earlier about, some shorting utilities. What's your criteria for maybe shorting other companies that are not utilities? Especially, are there sort of solar plays that you see that you just say, okay, this is fraudulent or this doesn't make sense, we're going to short this company? And if so, what's the criteria essentially?
So, shorting stocks is something we do. Our funds are long short. We think shorting is a very useful part of our investment discipline. With that said, shorting is very, very hard. It's in general a bad business. Even during the 22 years of Esplanade Capital, it's gotten worse and worse and harder and harder. Once upon a time, if you as an investor or a trader saw a compelling short, you could almost certainly borrow it. So you could do it. There, you made money while you waited because you sold the shares, the money sat in essentially an escrow account. You got a chunk of the interest income associated with that. I know it's been a long time since anyone got any interest income on anything, but you used to get paid to wait. There were rarely buy-ins or short squeezes, which could take you out of a position that you wanted to stay in at the worst time. And it was actually a better business. Today, it's the opposite of all of that. The best shorts you can't borrow. You pay a usurious rate for the right to borrow the shares. So you have to be wildly profitable in some cases just to break even. They are prone to wild short squeezes in general, and more recently from, let's call it the Reddit Wall Street Bets crowd. And by the way, a lot of businesses that seem, and I want to use air quotes for seem, like great shorts. For example, many extremely respected, smart, thoughtful investors and traders around the world, have viewed companies like Tesla as an incredible short for 1,000%. So sometimes you're just wrong. And the world we live in the past 10 years, which has been such a unique environment where such enormous, profitable, valuable companies can be built so fast, whether it's Tesla, TikTok, Uber, you pick, you fill in the blank, that, shorting is a very, very, very tough business. With that said, we do it. When we do it, it falls into a few different categories. One is the pure alpha generating single security short, where we have a list of criteria, and I'll come back to that make it a compelling risk reward short for us. That's one. Two, it's a pair. We love Coke, we hate Pepsi, we love, Sunrun, we dislike their competitor, whatever the case may be, and we seek to manage volatility and extract alpha that way. And then finally, just as hedging, we may have a portfolio of energy transition stocks we love, but fear some bad policy news coming next week and seek to hedge the portfolio through a basket of shorts, et cetera. So they come in different flavors. We do all of them. But in terms of the shorts themselves, it starts with the mirror inverse of what you look for in a long position. What do we like in a long position? We love great management teams with a demonstrated track record for success and a vested interest in achieving it when we're on the same team. We like compelling valuations, and we can, describe that in many different ways, whether it's free cash flow yield, replacement value, PEs, enterprise value to EBITDA, whatever we think is relevant and fair, and however we think the world values the company in question. So it's cheap. It is going to beat earnings, raise guidance. It is growing more quickly than expectations. It is disliked by the analyst community. It is underowned by the institutional investment community. The future exogenous news is better, not worse. It's sort of all of those things and our proprietary research and modeling thereof. But on the long side, we love catalysts, but we don't need them. On the short side, they are absolutely essential. And as a rule, we don't short without the catalyst clearly in our sights. That doesn't mean that we're guaranteed to be right. It just tilts the odds in our favor. If we have a long position, if I, expounded on something right now to your illustrious audience and said, here is a wonderful company. Management owns 20% of the stock. That's how they get rich. They are going to grow top line 30% next year. Wall Street thinks it's only 20. They're going to grow earnings per share 40% next year. Wall Street thinks it's 25. No one in the institutional community owns it. It's sell rated by every analyst on Wall Street. Oh, and by the way, it trades at 2.8 times forward enterprise value to EBITDA. You'd say that sounds pretty good to me, and you'd probably want to go buy some. For us, it would be great if we had a very hard tangible catalyst that accelerated or de-risked the long investment. But at 2.8 times EBITDA, unless we think that 2023 is a disaster, which in this hypothetical case we don't, we'll wait. And if the stock does nothing for a year, chances are it's an even better value and our confidence continues to grow, and we'll buy more. If it goes down, we'll buy more. So we love catalysts on the long side, but we don't need them. If there's really value there, some activists will find it too. They'll do the work for us and we'll win. On the short side, however, things can get so much worse before they get better that without that catalyst clearly in view, you're really better off waiting. And, I joke on the long side about, people who are afraid to catch a falling knife, et cetera, et cetera. And there are a lot of very thoughtful, very successful investors who would rather buy a certain stock at 15, quote unquote, on the way up. Now, how you ever know that it's on the way up is beyond me. But I think what that means is it went to 10, but then didn't go lower than 10 and is now at 15, and it's somehow safer at 15 than it was at 10. That's not typically how we invest on the long side, but I get that many people do. On the short side, I'm willing to take the other side of that because everything is about risk reward. And with the right set of catalysts and news and factors, certain securities can be much better shorts lower. When you have open-ended downside, certain stocks might be better shorts at 20, quote unquote, going down than at 30, not knowing. So sort of holistically, that's how we think about shorts. But again, from a risk return profile, if we do a lot of work and find a wonderful long-term investment, Hannon Armstrong that I mentioned earlier, that stock can triple. We can make a 700 basis point position turn into, if we kept it all and didn't hedge, a 2,100 basis point position, creating 1,400 gross basis points of performance. Now, again, we might trim along the way, et cetera, but that can make your year for a fund. Whereas on the short side, we're going to size it smaller because if we're wrong, it becomes a bigger problem. Risk management has us just with smaller shorts. And if we're right, and it really is a disaster, it gets cut in half and we make 150 basis points. There, we have sort of a 10x opportunity finding a great long versus a great short. Again, we do it because it does add value from a portfolio perspective. But in terms of, what gets you out of bed every morning, Itai, what can, make your portfolio and career, you'd much rather have a few good longs as opposed to a few good shorts.
Yeah, absolutely. And that makes a lot of sense. And you also spoke about Tesla earlier. How do you see, especially in the US, how do you see sort of the EV market playing out? Do you think that companies that maybe are newer like Tesla or, are going to, outperform and have these very sustainable sort of competitive advantages and moats over these more legacy car and automobile players that are trying to transition into the EV space?
So again, we have no position long or short in Tesla and haven't for many, many years. It is, a sort of once in a generation type of company, and their products are sensational. And I give them enormous, enormous credit. There is room for multiple winners in that space. And when we see other EV products that have come to market in recent years, many of them are quite compelling. And I'm talking about from legacy operators. When we think of Porsche, Audi, when we look at the new Ford F-150, there are compelling offerings. And when some of these companies have committed to going all electric within a decade or within a reasonably short and finite amount of time, it is going to get more and more and more competitive. With that said, we're approaching a time where people won't necessarily think about electric versus not electric. They're just going to think about buying a car. And so in that respect, if Ford or Chrysler wasn't a viable competitor to Tesla before, they still probably aren't going to be. I think Tesla's life does get harder and harder on the margin because you have big incumbent players who are, in some respects like legacy airline carriers around the world who struggled to compete with, the Ryanairs and the JetBlues of the world. But with that said, they do have a lot of capabilities. They know how to market. They know how to build internal combustion driven cars. They know a lot of things. And I don't think they make your life easier. They make your life harder. At the same time, we have, very well financed, relative startups, the Lucids of the world, which again, that was Tesla more than 5, but less than 10 years ago, with, more resources than Tesla had at the time. It was touch and go for a while. So I think that world does get more and more competitive. I think that's a wonderful thing for all of us as consumers, the opportunity to get just superior products for less and less money. I think it's very good for the environment as just the pace of electrification continues to ramp. But it's a tricky place to invest because on the one hand, you have what's been, a supply constrained market, but an incredible time to make and sell a car. Any car you want to buy today, just add $5,000 to the MSRP. I mean, it is a crazy and historic time. That won't last forever. And so I think it's going to become a more and more competitive, tougher and tougher world. But again, since we're not likely to own any of the stocks, we're more likely just to buy a car. That makes me kind of happy.
Yeah, I think that makes a lot of sense. And also, so we've seen especially more in recent times, a push to have more activist voices in some of these oil majors and to have them switch to renewable energy. Do you think that that's going to be sort of a successful sort of transition for them? Or do you think that, some of the old sort of bureaucracy and the old sort of leadership culture, some of these oil majors and the way they view their assets is going to really prevent them from making that pivot into renewable energy?
It's going to be a very, very hard transition for virtually all of them, but some will succeed and some will fail. Those who succeed and fail will in some cases do so voluntarily and in some cases because they are forced to. When you have a company that has become one of the most valuable companies in the world for multiple generations, it's quite understandable that you would be a believer in what you do. Judgment aside, morality aside, it just makes sense, the way that ExxonMobil has made money since it was founded is essentially the same way. If you run General Motors, again, it's the styles have changed, the management teams have changed, but it's basically the same recipe. So asking, any animal to change its stripes is a very, very difficult thing. So it's going to be hard. With that said, a lot of activists are making inroads because it's not that it's just fashionable and feel good. It is undoubtedly the right answer for a lot of shareholders in these companies. And again, it'll be different. It will have different characteristics than the old business, where it might have been, invest 10 billion and get quick paybacks. This may be slower payback. It may be a different payback. And what we don't have is that scientific, double-blind peer review. We will never know what would have happened to an integrated oil super major if they had just played out their hand. And my guess is they would have made, higher windfall profits right now and for some period of time, but the tail would have been shorter and more abrupt, but we'll never know, because a lot of them will not be allowed to play that game or will choose not to. And when they choose not to or are not allowed to, some will win because they pivot is too strong a word. They evolve, they recalibrate investment priorities, and some will fail. I think Roger Smith from Roger and Me, back in the famous movie about GM, I think he had a quote that said, as chief executive, he really only controlled two things: headcount and capital spending. And think about, you boil it down to that, and it's the capital spending that's really going to matter here. Where do these huge monoliths put their next $10 billion? And again, in part because of activism, and in part just because of thoughtful shareholders and thoughtful management teams, they're going to, put their cards, they're going to put their sort of roulette chips in different places on the board, and some are going to win and some are going to lose.
Yeah, absolutely. I think that makes a lot of sense. And what would be your pushback, if there is sort of pushback, to people who say, I'll play sort of this renewable space, I'll play sort of this electric vehicle space, but I'll do it more from the perspective of the metals that's being used in these, and I'll buy some metal miners who are copper miners or who are lithium miners. What's your pushback to that, if there is pushback?
You just have to understand, is it the tail on the dog or is it the dog? So once upon a time, we were visiting a Chinese solar wafer manufacturing plant. And basically what they do is they had at the time, there were these steel wire saws that cut these huge ingots of polysilicon into like potato chips. And that's the building block of a solar panel. And we saw these boxes with a company called Beckert. It was a European company, public, but almost sort of had a feel of a nice Warren Buffett style family business that originally made their fortunes selling steel wire cord to tire manufacturers, where you really want the strongest, most reliable steel in the world because it's your link between your car and the road. They started to sell more and more to Chinese solar wafer slicing manufacturers, and that was a booming, booming business for them. So I'm telling this story because it's germane to what you're talking about. If, much like certain metals providers today serving the renewable world from solar to storage and everything in between, if it's really no longer the tail on the dog, but the dog, then that's interesting. If you can find a good company at an undemanding valuation with those growth drivers, good competitive position, terrific. If, however, it's really 4% of their revenue growing to 8% of their revenue, and the 96% or 92% you really don't have a clue about, and maybe it's highly volatile, maybe it's even servicing the oil services industry that might be a little bit wary of. That can get you into trouble. When you have a differentiated view about a second or third derivative, wonderful if it really matters. But you can also overthink and overcomplicate things. And sometimes if you really have a belief, go with the first derivative. It's most predictable. And if you can find a quality company at a reasonable valuation, just do that.
Yeah, I think that makes a lot of sense. I want to go back. I think it's amazing to me, sort of the adversity that you faced when starting your fund. And so can you discuss sort of, the challenges of starting a fund? What was at the trough? What was sort of your lowest point of assets under management? How much assets under management did you have at that point? I guess, what's your advice to students if they also hope to start their own fund?
Sure. So, when I started the fund, we started the fund with just over $1 million. It was essentially a dozen intrepid souls who in 1999, during a raging bull market, said, Shawn, I trust you. You're a nice guy. You seem like you're not stupid. Here's a little bit of money. What's the worst thing that could happen? And the worst thing that could happen was the stock market proceeded to go down 40%. So, starting your own fund can be the greatest thing in the world. It is hard. We lived through that. We lived through the dot-com bust and the wars. We lived through the 2008-2009 global financial collapse. We lived through the pandemic. I'm hoping that we're all, as a world, as a global community, coming out of that finally. I would put March 2020 up there. We saw things that seemed every bit as catastrophic as the global financial collapse in 2008, 2009. At the time, people were going to ATM machines to take a little bit of extra cash out because they weren't sure if there would be money in that ATM the next time. We saw stocks that we liked in February, March 2020, fall by 90%, 90% in literally weeks. So, investing is hard. Running your own firm, starting your own firm is harder because you have all of the investment fun and games that can make you crazy and miserable. And you actually have to run a business at the same time. You may have employees, you have investors to answer to, you have compliance, you have payroll. It really is a business like many others. And so, I think you have to love it. You have to believe in a very data-driven fashion that you have something to bring to the table. For your audience, it's probably that you think you're excellent investors and traders, and I hope you are. At the same time, if someone in your audience thinks they're just a fabulous marketer, then they'll probably be pretty good at it too. Half of investors underperform, right? And many folks who start their own firm overestimate the importance of the craft, the investment side, and they really underestimate the importance of marketing and selling and communicating how terrific you and your strategies and your firm and funds are. So, my advice is to, know what you think is special about you. And to the extent that you can get real life experience and education, not just at Brown or at school or business school, but in the trade with other terrific investors or traders, mentors, to learn how to live through 9/11 or the global financial collapse or a pandemic or merely just a bear market. to the extent that you can learn from other people who have done it, who would do it well, that will just propel you so much more quickly with so much less risk. So just a few thoughts on that, world.
Yeah, I think that's really terrific advice. Since you had a very, at a certain point, you only had $600,000 essentially of assets under management, and it is expensive to run a fund, you probably had negative cash burn for a while. So do you sort of recommend, what did you do? Did you sort of use your own savings to fund that? And if so, do you recommend that people sort of have substantial savings of their own before starting a fund?
Yes and yes. Plan for the worst and hope for the best. So whatever you think your AUM will be in years 1, 2, 3, lower it. Whatever you think your returns will be, lower them, and plan to invest in your business. Think of it as a startup business where you are the venture capitalist. And if it happens quickly by performance, luck, anything, wonderful, but let that be a very pleasant surprise and get started by planning for the worst, because oftentimes that is exactly what'll happen by no fault of your own. It might be the markets, it might be world events, it might be just a bad run of performance, even if you're Warren Buffett.
Yeah, absolutely. I think that makes a lot of sense. And you've spoken a little bit about the casino industry in the past. What are your views on the casino industry today?
We're not terribly active there. It's in March 2020, the pandemic was the worst thing that ever happened to casino and casino related companies worldwide. Today, it appears to have been the best thing that has ever happened. Profit margins, growth are at all-time highs in most casino markets around the world, except for Macau. It's astonishing. I've really never seen anything like it. And as a result, with profits and margins at all-time highs and expectations very high, it strikes me as a very, very difficult place to be today. Added on to that are, mobile gaming, legalized sports betting in this country and places around the world. A lot of people are trying to feed at that trough. A lot of them are actually losing money doing it. It just seems like a very, very complicated place to be right now.
Yeah, absolutely. I think that makes a lot of sense. In the past, you've discussed a little bit Static Solar, Azure Power Global, Jinko Solar. Is there any of those that you can maybe expand on a little bit as sort of a case study?
Sure. So, we know all of those companies today and have for many years. We've been to their headquarters umpteen times in most cases, et cetera, et cetera. I think, without getting into any one specific one, I think the key is just to understand the business. And, the market can give you things that are very, very interesting. And though I won't name names, right now, it's been a very, very challenging, basically, year for a lot of solar related stocks who had great 2019, 2020, and January, February of 2021, and then basically went straight down. The average solar stock went down 40% from early 2021 to the end of the year. They're down more this year. So a tough neighborhood to be in recently. Number two, SPACs, where we're extremely active. A lot of SPACs have targeted the energy transition in the renewable energy world. Well, there are two companies that went public via SPAC that are solar pure plays. So they have gone public while solar stocks have gone like this and SPACs have gone like that. That's at least an interesting starting point. That doesn't mean they're necessarily both table pounding buys, but you have these two very strong market forces driving some stocks down. And if you happen to do the work and thought these were good companies with good competitive position and attractive outlook and sort of cheap valuations, for patient capital, and I want to reiterate that, patient capital, those can be really interesting places to start digging, and maybe you dig up a truffle.
Yeah, absolutely. I think that makes a lot of sense. And how do you think about portfolio concentration and position sizing?
So we think, particularly as a small firm, one needs to be fairly concentrated. I don't think there are 100 incredible ideas that you're dying to tell your investors and your wife and your kids and your friends about. I just don't think there are at any given point in time. And as a small firm, you want to feel that you're expert. You may not be, but you should feel like you are. And again, I think it's hard to feel like you're an authority in 100 or 200 different companies. So we really embrace concentration, fewer, better ideas, but stop short of massive concentration, which can lead to more volatility than perhaps you or your investors really have the stomach for. That can change your behavior for the worse, because the bottom line is bad things happen to good companies. And it can be the best idea in the world, but if a few things go wrong and your 20% long position gets cut in half, you might have to sell. You might have to do things you don't want to do. Whereas if that is more like a 6 or 7 or 8% position, still a large position by most measures, but one that's more comfortable for, say, our sweet spot at Esplanade, you can handle that. You can live and fight just, to fight another day. And you might actually be in a position where you can buy more at the most attractive levels. So, I mentioned back in the pandemic, you had some very, very nice stocks go down 90% that today are at all-time highs. So just imagine that, a 15 or 20% position down 90%, and you couldn't hang on to it. Someone said you have to cut that loss, you have to stop it out, et cetera, or you just psychologically couldn't take it anymore. And then it not only went up 10x, it went up another 10x. So we're concentrated, but not too concentrated.
Yeah, I think that makes a lot of sense. And just to clarify regarding what you said about SPACs, you're looking primarily at SPACs that have already, announced the merger and have already merged, or are you looking at any? Yeah, okay, that makes sense.
So we look at both. We've been very successful in pre-deal announcement SPACs, but that's a very different animal. That's almost more of a fixed income with an option strategy. But the couple I mentioned were where they announced and consummated deals and are now publicly traded companies. They just happen to be born out of SPACs.
Yeah, I think that makes a lot of sense. And let's say there's, someone today, let's say a college student who, aspires to ultimately reach what you've reached, and that sort of this has similar interests to what you have in terms of investing, and also wants to, one day sort of fund. What is your advice for them in terms of, for example, for undergraduate, should they major in economics, do you think? Should they major in something like that's more tied to renewables and renewable energy? How important is, an MBA? How important is like a CFA, for example? What sort of internship and career opportunities should they be looking at, et cetera?
So I have an MBA. I love business school. I think it's a very valuable tool. But with that said, when I look to hire my first employee at Esplanade Capital, I put in the job description, an MBA is neither required nor preferred. So this is a business where you definitely don't need one. It's a wonderful thing if you find the right school for you. I also don't think one needs to or necessarily should major in finance or economics. I think the key is majoring in something that allows you to demonstrate incredible analytical skill and achievement. And maybe that's physics, maybe it's math, maybe it's something totally different, but something that allows you to hone your analytical skills. And then you can sort of minor in investing on your own time, read books, listen to podcasts, listen to experts, practice, learn. It's the doing it does not have to be what you major in. I think, Brown is one of, I think, the few greatest universities in the world, but last I checked, you can't major in finance, can you? So there you have it. Yet think of all the wonderful investors who have come out of Brown University. And I assure you, they weren't missing anything because they didn't take Finance 101 as sophomores. So think about thinking and analysis, and then, you can figure out the investing on your own time.
Yeah, I think that makes a lot of sense. And for a concluding question, what have been the most influential events of your investing career?
I would say, the first one was working with real companies. Before launching Esplanade Capital, I had never been a professional money manager. I'd just never done it. But I worked with real companies and real businesses, and these are living organisms. These are people. These aren't just ticker symbols that trade on Robinhood. No offense to Robinhood. So that was the most important thing, the understanding that these are living, breathing organisms made up of people and customers and leadership and all sorts of workers. And that's how stocks become valuable. I used to think that, Tom Peters' book, In Search of Excellence, was sort of the best business or investing book you could read because it talked about businesses, not stocks. With that said, I'd look at the crises of the past 22 years and say, those are really what have formed, a lot of what Esplanade is about, and living through them, navigating, eventually succeeding despite them. I think that's made us a chunk of who we are today.
Yeah, I think that makes a lot of sense. Thank you so much. This is a really, really tremendous session, and we really appreciate you taking the time out of your busy schedule to meet with us today.
Itai, a pleasure. Go Brown. Thank you very much. And good luck to all of us.
Thanks so much. You as well. Have a great day.
Okay, bye now.